Welcome to Bilingual Investing. Jay here with you guys today. Today's video topic is about global inflation and recession. These are some trying times for a lot of people throughout the world. This video topic, I've been receiving, again, a lot of questions, a lot of people talking about what's going on with the global inflation. Inflation's going higher. Governments and central banks around the world seem to not have, a full grasp, on inflation. And then we also have recession, panic, people, scared that, assets have been going down lately, like stocks, housing, real estate, precious metals. So, how can we have inflation on one end and then a recession on another, in essence, occurring at the same time? So today, basically, we're going to describe that. I want you guys to educate yourselves, basically on the macro economy, like what's really going on, the Fed raising interest rates as well, so that's what we're going to discuss in today's video. So, the first part of the video, we have, 3 sections as usual for the most part. Sometimes we have 4 or 5, but usually it's just 3, keeping it simple. Today's going to be about what is stagflation, so that's the terminology or the term that we can use to describe what's really going on with the world economy today, across the world, globally. For the first time, this is what we're seeing. Usually in the past, maybe certain countries, had high debt levels and made, a bad, monetary policy decisions. So we used to undergo, let's say, stagflation, right? But now it's global. It's about the world economy. So when that happens, usually it has a further impact, for the whole world and its citizens. So we're going to discuss that. And then after what is stagflation, we're going to go through, just the global inflation and recession that, we're either currently going through with regards to recession, or it's, around the corner. So we're going to discuss that. And then inflation, we've already been going through that essentially for the whole calendar year of 2022. So we're going to review that. And then, okay, Jay, we know what stagflation is. We know what global inflation and recession is and what that means. And we're going to describe that. So how to get prepared for uncertain times, that's really the main question of today's video that I want to go over. Okay, we're going through these things, but what's the best way to attack stagflation, or basically global inflation and recession? So that's what today's video is going to be about. So let's immediately start off with what is stagflation. Stagflation is considered to be when persistent high inflation combined with high unemployment levels and stagnant demand or deflation occurs simultaneously within a country's economy. That's a lot, man. That's a lot of things happening at the same time. For example, deflation or a recession by itself, usually it's hard, because there's high unemployment and also deflation on certain assets, so usually it's a hard time. But then when you add inflation at the same time, on goods and services that are essential, that makes the situation a lot worse. And that's where it becomes stagflation. So again, one of the main causes of high inflation is caused by excessive currency printing, or QE, or quantitative easing by the Federal Reserve or by central banks across the world, causing a rise of the currency or money supply. Based on fundamental economics, the more currency there is in existence, the less purchasing power it will retain throughout time. That's just, again, basic fundamental economics. That's just logical. That's the way it works. So, global central banks such as the Fed, the ECB, and the BOE, this is the US, Europe, and Great Britain or the United Kingdom, just to name a few, are being forced by current levels of inflation to apply quantitative tightening, QT, by reducing their balance sheets and implementing harsh interest rate hikes to crush global demand, thereby attempting to lower such inflation levels. So such actions also have a direct impact on the global economy by causing lower GDP performance, thereby usually leading to the creation of a recessionary environment. So let's actually just have a quick overview of what we discussed about, QT or quantitative tightening and QE or quantitative easing. So in this chart here, we have the balance sheet trends. This is for the Federal Reserve in the U.S. So, when you see it going down like this for these periods, periods, not many, because most of the time they're doing quantitative easing, injecting the economy with excess currency supply. So that's why usually you see that money supply, rising, going up here, going up drastically here, in 2020 with the COVID situation. And then, we see it go up here back in 2008 with the housing crash. So every time there's like an emergency or a recession, usually they raise the money supply, or they do quantitative easing. But when you see quantitative tightening, it's not common, but you see it here towards the end, 2018, 2019, you see the balance sheet going down. That's what they were tightening. And now you can see the curvature here where they're trying and attempting, to implement QT, but it's not, when compared, starting from here, it hasn't been much. So they're promoting, a hard stance and QT, but, we need to see more and more, not just the curvature up here, but we need to see it come down considerably, before, it actually works as they intend, in my opinion. But, we just have to wait and see. But usually that's how, quantitative QE, QT, that's usually how it works with regards to that. And then GDP is gross domestic product, is essentially how, how much, how strong is an economy? How much is that country producing, relative to their debt and their expenses and things of that nature. So, that's important as well, as we mentioned. And then we also mentioned the unemployment rate, right now is extremely low, as it's at, historically, low levels. So we also mentioned that. So usually in a recession, we see that spike, as in 2020, we had that brief recession. So now that's what we're waiting, as further indication of these recessionary times, is just to wait to see that unemployment, level or rate, to start going up, to, as another strong indication of a recession, as we're going to discuss further in this video. So again, stagflation is when GDP goes down, gross domestic product, how much, a country, or in this case is global stagflation. So globally, most countries, how is their GDP? Is it strong? Is it going down? So, and then we have unemployment going up. So again, when we mention, this unemployment, you see this brief spike down here. It could be the start of things, heating up, because these things take time. You know what I'm saying? So GDP is already going down. Unemployment is probably starting to go up. We have to wait and see. And then demand is going down. Demand, usually the assets, we're going to go over that too. Just how the housing market is going down. That demand, to continue buying houses and continue to buy certain things of that nature, is going down. And then with that, you have inflation as well, which we're going to show that chart as well, when inflation is going high. So again, when you have all these factors occurring at the same time, the stagnation are these three, and then inflation is over here. That's where the stagflation comes through. So let's actually go ahead to the next slide. So let's discuss global inflation and recession. Again, inflation is hard, when the food is going up, when gas is going up, and all those essentials. But then you have a recession, essentials, I meant to say. But then you have a recession where the assets that you hold, like precious metals, cryptos, stocks, they're going down at the same time. So it creates for a harsh environment usually. So again, it's relevant to first comprehend the following. Inflation is the rate at which prices for goods and services rise. Deflation is the rate at which prices for goods and services decline. And then a recession is when there's a general decline or contraction of overall economic activity. So the current global stagflation is causing nations to concurrently have to deal with inflation and deflation at the same time, or a recession. So such stagflation is devastating for economies because it causes them to essentially experience three very uncomfortable economical situations all occurring at the same time. So let's start with number one, a lack of economical growth and price depreciation via deflation, mainly in investment assets such as cryptocurrencies, precious metals, real estate and stocks on one end. So let's actually go through that first part, the deflation. So let's actually put this over here. Let's go through the deflation. So let's take Bitcoin and cryptocurrencies, for example. You can see that it reached an all-time high essentially at the end of last year, 2021. And then ever since, it's been deflating. It's in a bear market. This is where you see the deflation or the deflationary pressures against this asset class. You can see for the whole calendar year, 2022, it's been going down. It's been deflating. Then you go to gold. Same deal. We had a double top, one in 2020, one in this year, 2022. And then ever since, what has it been doing? Deflating. Again, you can see it clearly here for most of the calendar year of 2022 after this, double top formation. That's what it's been doing. Gold, which is a precious metal, has been deflating. The next big precious metal has been silver. And again, since the early parts of 2022, it's been after the double top back here. We've had what? Again, just deflation. The asset price has been, mainly going down, deflating. So if you held to these assets, they've been going down. And again, we have the stock market. We made all-time highs, and then that was basically January 2022. And then for most of the calendar year, what have we been doing? What a surprise. Deflating. You can see the deflation and in these asset classes just going down for most of this calendar year of 2022. So that's the first part of the stagflation. The second one is while inflation causes a drastic rise in prices for essentials such as food, shelter, or rent prices, energy, and certain commodities such as natural gas and oil, for example. So let's actually go, through these. Again, we talking about inflation. So before we reveal the assets here, we have the inflation, which is currently at about 8.30% for the U.S. Currently we have to wait and see next month when we receive, the updated inflation data. So again, we're currently at 8.3. Yeah, we've reversed for the past month or two, but we're still up here. Reversal, in my opinion, a stronger would be, to see that come down like this, not. But you have to give it time, right? But again, inflation is high. Look at that. Essentially since 2020, after COVID and all that stuff, that's when, the inflation started after all that money printing, people receiving checks, free money everywhere. So now the consequences have been reflected, via inflation, as we can see in this chart. Then, oil, the same thing. We've had a pullback now after the Fed has been raising interest rates and things of that nature. Just briefly here, lately for the past couple of months. So, but, since 2020, again, we see the inflationary pressure in oil, and that was reflected with gas prices increasing as well, earlier this year, 2022. So you can see that inflation affecting this commodity as well as natural gas. Europe is currently undergoing with, that energy crisis. As we can see, look at that. The natural gas, essentially, since 2020, look at that, just inflating, going higher. We've had a recent pullback recently, that's just in the short term, but you can see the trend, it's been going up, inflating, causing a crisis, in Europe over there. It's not easy, but again, you just see that. Same with the Schiller index, with, housing, things of that nature, mainly after the health crisis, again, you see that spike up, in home prices. Again, we see the curvature here and, somewhat of a downturn here lately after the interest rates hikes and things of that nature. But for the most part, for 2 years, housing just was exploding towards the upside. So you can see how that market was inflated as well, due to the money printing and inflation affecting that, as well as rents. Rents across the U.S., earlier this year in the summer rose above $2,000 for the first time ever. So, that's the average rent price. So again, when you see things like that, it's concerning, when for the first time ever, there's a median rent price of $2,000. Man, that was hard. That was hard to see that, that thing, inflation just creeping into, the most important things like certain commodities, like energy related commodities and food and rent and things of that nature. it's important to keep these things in mind. And then number three, lack of economical growth via a recession, where we see two negative quarters of GDP growth, therefore eventually causing high unemployment levels. So again, with regards to the unemployment levels, usually that's why we expect, in my opinion, that rise moving forward. But we have to wait and see, mainly because of the GDP. We see here that we have back-to-back contracting GDP levels or percentages for the U.S. And then we're going to get the Q3 information or data soon as well. So we have to, see that. Stay tuned. We haven't had this yet. And usually when a recession happens, this is what, we look forward to, where the GDP is gravely affected. Maybe not to that extent, but also this has been minuscule in a sense, but it has been back to back. And usually, if we can read here, let's see. The U.S. economy contracted, as we see, so hitting a widely accepted rule of thumb for a recession, which is that, again, back-to-back negative GDP growth. So, that's also affected by, again, a recession. So we're just waiting on the unemployment level part. When that starts rising, that's where we can be like, okay, we've confirmed, a technical recession here in a way. We already have the first part, so we're just waiting on the unemployment level. So again, central banks and governments via centralization have caused a negative impact to their economies via questionable monetary policy decisions, mainly due to human greed. Successfully undergoing as a society through the decentralization of money and power will become an indispensable part of our future, moving forward. So again, we can also see here recently, homes. This is the real estate sector fund, going down. So you can see a little bit of deflation for the short term. You know what I'm saying? And then also, to confirm a recession other than the housing going down, we have the stock market. We see a 25% declines from the previous all-time high. We mentioned on the unemployment. That's what we're waiting for. So those three factors are great indicators that we're either in a recession already, or we're basically just around the corner before that factor comes to a full-blown, recession. And then we did mention, the interest rates hiking. You know what I'm saying? That's a big factor lately with the Fed being aggressive. So that also helps the deflation in the assets that we reviewed previously. And it also makes lending harder. So usually affects the housing market, as we reviewed, in this chart here. So that's a key factor. We have to, stay tuned to see how that's going to continue affecting asset prices. And then obviously we have the DXY, the Dixie, when the dollar is strong as well, that also massively affects, precious metals, cryptos, real estates, and now even commodities such as oil and natural gas, we see short term, going down too. So those are all things to keep in mind. So again, how do we get prepared for uncertain times, Jay? Global inflation and, a global recession cause uncertainty and panic throughout the world. As a consequence, global debt rises to unprecedented levels, causing further pressure against the economies, the different economies around the world. It is important to understand that these events are but a reflection of human behavior. Human centralization of power and greed are to blame for such occurrences. So here we can see, the global debt topped a record $305 trillion in Q1 2022. Man, so imagine in 2024, we're going to be probably exceeding the 500, trillion dollars by then. Who knows, man? Even a quadrillion, man. The rate of increase that these, central governments are going through is just massive. It's incredible. Central banks, things, that has been normalized, not just for the consumer and for the regular citizen, but also for all, central governments around the world. So that's dangerous. That's a dangerous game that they're playing. As we can see, the U.S. national debt essentially at $31 trillion just by itself out of the 300 plus trillion around the world. So you see these numbers, they're always going up. This is the debt clock, is a beautiful tool. I might leave the description down below, but again, you can come here and see that per citizen, that per taxpayer, the deficit, their spending, just annual, spending and GDP, but then, the federal spend, things of that nature. Man, Look at that. Total debt to GDP ratio, 137.89%. Man. And then the cool thing is that there's definitions, up here once you scroll over it. So that's good, great educational tool. So again, guys, important pointers to keep in mind, as a summary and conclusion, no one is coming to save us. We are responsible for our own well-being. Keep that in mind. Stop being reactionary. Become preventative. Think ahead. Become a forward thinker. Think about everything. Details matters. Control what you can control. Having bad debt has become normalized. Don't become or don't be normal. Start by making sure you're debt-free, or at least on the path of becoming debt-free, by eliminating all bad debt. Create consistent cash flow and alternative income streams or side hustles. Control and limit your spending. Do anything and everything you can in order to survive what for some may be, these trying times. Have all liabilities covered for and taken care of. Have access to some funds or savings for a rainy day. Invest the rest responsibly with the goal of ensuring that you're properly hedge against a worst case scenario. So what, all of these assets have been depreciated due to everything that we discussed in this video. So again, this is not official financial advice. You guys do as you wish. This is, this video is for educational purposes only. But, you can invest in depreciated assets like cryptos, precious metals, things for that nature, dollar cost average. And again, for the long term, not expecting too much, short-term gains, just to hedge things that are decentralized, things that you can hold, that are tangible, that are yours, things like Bitcoin, things like cryptos, the decentralized ones, things like, gold and silver, or maybe land or real estate, things of that, even though they're currently going down. And I'm not saying you have to buy right now, but just things that you want to hold on to, and hedge against these currently trying times. So again, have options, have backup plans, become flexible, be ready to adjust and adapt to any situation that comes your way. So again, hopefully this video has served its purpose, to educate you guys, stay safe out there. Good luck with that with regards to that. And again, guys, let's actually look for this right here real quick. Here we go. Make sure you guys, if you enjoyed this educational content, make sure you guys like this video, guys. Make sure you guys come to our website in the description down below. You can find tools and resources that you might need. And then again, come swing over to our channel, sub to our channel, click on the notification bell to stay tuned for educational videos like this for free. And we're, there are subs. Thank you so much for subbing. We're going up little by little. We really appreciate it. And again, thank you so much for your time and attention. Jay here with you guys today. Again, this content is not official financial advice. It was created exclusively for educational purposes only. Have a good one.